Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our podcast, we do a weekly podcast. We try to give you the good, the bad, the ugly on what's going on in the economic world, the political world, anything that can affect you and your real estate decisions. Joining me, as he does every week, is Louis Camorosano. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, MSN, and numerous others. And like I said, what we're going to do today, we got a lot to break down. We've got initial jobless claims. We have the Fed minutes that were released yesterday. We're going to jump into FHA trimming their waiting period back from the time period that you can buy a house again for if you had a foreclosure, short sale, bankruptcy. We're also going to dive into if the actual housing industry is actually helping to rebuild the American economy, as many are saying. Louis, how are you doing today, buddy?
I am doing grand, Ryan, and you?
I'm doing great, sir. You know, we obviously got a lot to dive into today. The first thing on deck, obviously, we had initial jobless claims, which came out at 8:30 this morning. The number, I believe, was 336,000, which was higher than the consensus estimate of 322,000. And I believe that also the numbers from the prior week was revised slightly higher as well. However, many analysts they follow that 4-week moving average, which fell 2,250.
Right.
So it really, at the end of all this, even though the numbers were worse, it ended up being a moot point. It's like not doing anything at all. Rates are not, getting better necessarily like they should, just because of the claims is actually worse. You and I talk ad nauseum about this stuff every week, but it's interesting because it's like, any time that there could be potential negative news, they always spin it to be to where, it's still not as bad because look at the moving average of 4 weeks still going down.
Oh, Ryan, I got a better one. This one comes from your buddies over at Reuters. Here's the tweet they sent out. U.S. jobless claim rise, but trend hits at quicker hiring. And I wrote back, what? Did you just make that up? How does rising claims equal quicker hiring? There is no evidence whatsoever that when more people lose their jobs or fewer people lose their jobs or anyone losing their job means someone gets hired, and it certainly doesn't mean the rate of people getting hired is going to increase. I just don't understand why they feel obligated to somehow put that spin on it, that people losing their jobs or the rate at which they lose them somehow equates to hiring. It absolutely does not. But that's what I see every week. AP does the same thing. Reuters and AP are the worst at it, of constantly saying that when the fewer people that lose their jobs, the job market is improving, even though the labor participation rate continues to go down. And my contention is there's just fewer people left to lose their jobs, and companies have basically stopped firing a lot of people. They slowed their pace of firing because they're either switching over to part-time workers or they've already toned down their workforce over the last 5 or 6 years to the point where they really just don't need to cut anymore. That doesn't mean they're hiring more people.
Right, and and these same news outlets are not actually providing, why don't they talk about what the actual unemployment rate would be when you factor in all the people that fell off because they've been on unemployment for too long or they're part-time workers? Why don't we factor in all those and we start to get to that 16% number? And then why don't we talk about the underemployment number for the people that, basically just have part-time jobs. They don't have full-time positions. And between the ages of 25 and 40 is something like 24% underemployment rate. I mean, those numbers are the numbers that you and I care about because that actually shows, where we're headed as an overall economy, not these initial jobless claims, which factor out so many things, doesn't take into consideration that majority of these jobs are really just part-time jobs. They're not full-time positions. And how can you have a productive economy? Typically those part-time positions don't last that long. I mean, people that typically take part-time positions will stay at one place long enough until they can find another higher-paying part-time position, so they're job hopping all around. You know what I mean? There's really
worse, Ryan, or they'll find another part-time job, and they won't be fully dedicated to either job.
Absolutely. They could have two part-time jobs, both of which just, They just have them because they need to be able to make enough money to support, driving to work for one, and taking care of their overall expenses that they have. And it's almost like clockwork, Louis. You and I have said this before, but when we have some sort of news, I mean, obviously we've seen interest rates getting much worse. Once again, Wall Street and the whole world is basically watching everything that the Fed's doing. I thought it was interesting because I just put in a Google search this morning and I just put Fed minutes in. And I just wanted to kind of read these headlines straight down the page without even jumping into the articles, because I think it pretty much tells you everything you need to know what the United States and the rest of the world is thinking. The first is Fed minutes. Policymakers favor tapering this year. Fed minutes. Bernanke looks set for September taper, but not a done deal. Fed minutes shows cautious moves towards end of economic stimulus. Few clues on timing of QE3 reduction in Fed minutes. Asia braces for big falls after Fed minutes. Wall Street falls after Fed minutes yields few clues. Stocks plunge as Fed minutes cause volatility. I mean, you pretty much think that the world's coming to an end because of everything that the Fed does and says. And as we got a clue yesterday, the Fed minutes basically came out, which is basically just a review of who said what in the last meeting. It was very evident that the majority of all the members were on board with basically not giving an exact timeline for when they're going to taper. And you and I spoke about this, Lewis, and said that, we didn't feel that the Fed, after the last slip-up where they basically said, hey, we're going to taper in September, that they're going to give us any clear indication from now on as far as a month, as a cutoff period, as to when they're going to have to start doing stuff. They're going to basically continue to say, when the data says we must do something, we will do something. And that will continue the trend of kicking the can down the road. They got themselves in trouble the first time. I think they've learned from it, and I think that this is going to be much of the same. I feel like we're going to go through the end of this year without them touching this because the numbers don't show any sort of economic improvement. Fed Bullard said he wanted to see a second-half rebound before they even considered tapering. And if I was sitting on that board, there's no evidence that you could possibly have that would say that we're turning the corner. Would you agree?
Brian, I'd agree, and if you're absolutely right, and if you read the minutes, they agree. They sound so confused. They say, well, the data isn't that good, and we're really concerned, but we're going to taper anyway. We're definitely committed to tapering, but we're not sure when, but we're going to do it, by golly. It's ridiculous. They're admitting the economy isn't recovering the way they wish it to, but yet they've got it in their craws that somehow they need to taper because Bernanke said it back in June that they're going to do it this year. They're going to do it in September. So now they want to let everybody know that they're going to do it, even if the data goes against what they want, because these guys want any excuse not to taper. But they've somehow kind of using this reverse talk where while they want to taper, they don't want to taper, they want to continue QE, the data is not coming in the way they like it, but yet they're saying, but we're going to taper anyway. It doesn't make a stitch of sense.
None. And I get the question often now because everybody said, well, you had warned us, you had said that, if you're trying to obtain a mortgage right now, that you'd want to lock in your interest rate ahead of the Fed releasing their minutes and things like that. And obviously they released their minutes. They didn't say, yes, we're going to start tapering in September, so why wouldn't interest rates get better? Well, here's the deal now. Everybody, everything is kind of already factored in that they plan on tapering. It's just a matter of when. What's happening
and how much.
The problem is that about half of the members now support a move now and half need more data to decide. So the way Wall Street's looking at it is before there was really only one voting member that supported a taper, then there were three, now it's half, right? So there's growing momentum that this is going to happen at some point, and that's why these mortgage-backed securities are selling off, and that's why we see interest rates getting worse because everybody on Wall Street is trying to time it. They're trying to be ahead of the curve. So the only way that they can do that is to start selling off now. They're not going to wait until it's too late, and that's when they lose their tail. So everybody is trying to, forecast and predict and get out ahead of the Fed, and that's why we've seen such a drastic increase in rates. It's not because of specifically what they're saying. It's Wall Street's trying to stay in front of it. And as a byproduct of that, everybody is suffering because there's higher interest rates at this point. Now, granted, when I say higher interest rates, we're still sub 5% for most people. Those are fantastic interest rates. And for people that continue to tell me that they feel like Well, they don't have a choice but to let interest rates go back down to the 3.5%-4% range. Well, I don't see that being the case here, because realistically, they should have never gotten there to begin with. But since they were there, and now the growing sentiment is that they have to taper, there's no way without the Fed actually doubling up their purchase of mortgage-backed securities that we can get rates back into the 3% range.
No, you're right. They've gone up just on talk. To get them back down, they won't be able to talk them back down to where they once were. They're going to have to buy more mortgage-backed securities and more treasuries.
Yep.
But they're all saying they don't want to do that.
Yeah, and so the question is, Louis, is at what point does the Fed almost have to, go back against their word and say, you know what, I know we said that everything, looked like it was turning the corner, but actually things are getting worse. And now we actually need to buy more treasuries. We need to buy more mortgage-backed securities because that's the only thing that we have left to do. We don't.
Ryan, this is what we've been saying, is that they know that if they were to pull the stimulus or the QE, whatever you want to call it, the economy would collapse. They can't admit that because on the other side of the coin, if they say that we're going to just keep printing, they will lose confidence in the dollar. And it's kind of an odd situation because if they stop printing, they also lose confidence because people are attracted to U.S. Treasuries and the dollar because they know the Fed's good for it and they're always going to keep printing. So they're in a classic catch-22, and that's why you see this type of confusing talk. But they will, you are absolutely right, they will find something to continue to taper. To continue the QE and not to taper. And if they can't find something definitive enough, they'll make a mountain out of a molehill. But even if they can't, if they actually do taper just because they want to be men and women of their word, they'll just go right back when they see the reaction to it and turn the spigot back on and continue to print. Look, you got Syria, jobless claims, India's currency collapse, if housing starts to fall, stock market, Egypt, budget talks coming up. Any of those things could be an excuse to say, look what's happened to the markets. The Fed has to come to the rescue. Look, we were very sincere. We wanted to taper. We didn't want to continue this QE, but we're going to have to do what we have to do. We're going to take the bold step and print more money. That's what's going to happen.
And you know what? One of the ideas that's been tossed around, Louis, I don't know if you've seen this or not, but it was basically where the banks, like all the banks that are out there, their excess reserves that are basically going to sit with the Federal Reserve overnight, that typically they get paid a certain rate of return.
Right.
We're talking about taking those excess reserves and having them overnight buy Treasury bonds. Right?
That is self-dealing. That is crazy. They're going to actually buy the bonds. No, sell. How's it? It's a reverse repo. They're going to sell the bonds and buy them back the next day. And guess who makes money on that? The banks on the fee for the transaction.
Yeah. And
how does that take liquidity out of the system if you do it within a period of hours? And that's just shuffling papers around. Exactly. But somebody's making a fee off of it.
Somebody's making a fee off of it, and they're basically saying, oh, this is great because we're not actually adding to the balance sheets or anything like that. This is a great idea. And I could see it now, and then all of a sudden they'd be buying mortgage-backed securities or something overnight. You know what I mean?
That's digging a ditch and filling it back up and paying somebody a fee to have it to watch it be done.
Yep, you got that right. And
that's unbelievable that wasn't the headline. That this reverse repo idea, which does absolutely nothing to lower liquidity, it does nothing other than it creates more trading, for which the member banks of the Federal Reserve are going to get a fee.
Yeah, and that was I caught that blurb in an article, and now that thing has gotten buried somewhere because the only thing that's popping up now, of course, is everything with the Fed minutes and when they're going to taper. But what I find interesting is because we talk about this and we talk about the timeline, and we're always trying to say when we think something's going to happen. But obviously, we know that Bernanke's term is coming up, right? So his seat is going to open up, and while the board terms last 14 years, and he's basically has been there, 8 years now? In January.
Too long, as Obama says.
Right. And basically, with Obama basically saying that he's out, or saying everything but that he's not out, I would project that he's not going to be the Fed chairman come next year. And I think that's where we might see an interesting shift, is once we see who the new Fed chairman is come January. Not just that, but I think a lot of the governors are actually up on their terms as well. So there will be
and then some become non-voting and others turn into voting.
So I think that...
And I believe the ones that go into voting this time are more hawkish, right? I think right now that the whole slate is almost all dovish, the ones that vote. But you're getting a few hawks coming in the next round.
But wouldn't you agree that it's almost like, okay, this is like the end of any president's term, where Bernanke's not going to do anything. He's not going to make any serious moves here. We're going to drag through the end of this year with the same policies that have been in place. They're not going to do any tapering or anything like that.
He wants his legacy to be, he initiated this bold QE. He was a student of the Great Depression. He realized that, in his mind, the monetary policy needs to be needs to be easy when you have these types of mega recessions and you have a risk of deflation. So he wants to be known as the guy who instituted QE, got the economy back up on its feet, and was ready to taper and to stop the program and call it a success. But his problem is his timing isn't quite working out, because I think anyone who believes that QE helps would believe that they're at the point where they're not finished yet. And a lot of people that studied the Depression thought the same thing happened, I think, in 1936, 1937. They went back into a repression, had the double dip because they took their foot off the pedal. And I think that's what the fear is right now, except this time they've spent already trillions of dollars monetizing debt. That's something that's never really been done before. And what Bernanke wants is to say that he fixed it and then he left. And if it crashes after him, it's like, well, that's because they tapered or that's because they didn't taper. So he really doesn't know how to play this. I think, being a Keynesian that he is, he thinks that this QE should continue.
Yep.
And I don't know what he's going to do, because tapering a little bit just to save face is going to cause an immediate reaction. I think what you point out, Ryan, is they've been conditioning the markets for this for months. So they're hoping that some of the air comes out of the bubble so that when they actually do taper, they don't get an outright collapse.
Yep.
And then they can say they're men of the word, they did the taper, and if things get really bad, they'll say, look, this was unexpected, this type of collapse. So they'll go back to the QE.
Yeah, I mean, that's pretty much, you can, I think that they know now, I mean, obviously after their last flip when they basically came out and said, hard and fast, we plan to taper in September, then it was, they saw what happened to interest rates. The time...
But then they said, oh, no, we didn't mean September. Now they're saying they're committed almost kind of maybe to September, but definitely this year, I think, kind of.
Yeah, they're almost kind of sort of ready to do it, but yet almost all the committee members said it was still not yet appropriate to start tapering right now because, they still want to see when the economy improves, right? And
we don't see it improving, but we're going to taper anyway.
Right. Don't mention the fact that we have rising mortgage interest rates right now, right? So if
the whole economy, the whole recovery is based on low interest rates and the housing market, which is stupid to begin with. And now if rates rise and if they taper, they'll kill that and they'll also kill the stock market.
And the stock market, I mean, that is a ticking time bomb, if you ask me.
It's under 15,000 now, isn't it?
Yeah, and it is. I mean, and it's so funny because anybody that you talk to, the stock market, like I said, they're so analyzed on the Fed, but because they know that this scheme is coming to an end at some point, and they
want to be kind to the drug dealer. I mean, he's the one who's feeding them.
And when it falls, it's going to fall.
I mean, the Fed is the one who's feeding their fix.
Oh, absolutely. I mean, basically cheap interest rates, cheap money. I mean, it basically it leads to all kind of investment risk that you wouldn't otherwise take.
Malinvestment, that's correct. Just like in the housing market, you have all those cash buyers. They've borrowed that money for cheap, and they were able to go out and scoop up those houses and make investments. And now if they have to pay higher rates of interest to borrow the money, it's not going to be worth it for them. So they bought all those houses when it made sense to because the Fed was there. When the Fed pulls out, then it doesn't make any sense for them to invest. Well, maybe it wouldn't have made sense for them to invest in the first place if the Fed wasn't there.
Yeah. Well, so let me ask you this question. This is a question that many people have, Louis. Obviously, the Fed is saying, they want to focus on the economy turning around and the numbers improving as far as employment's concerned. I think that the Fed is actually looking at the real unemployment numbers and not the
Bernanke said he was. He's looking at underemployment and part-time jobs and the labor participation rate.
Right.
He says that the unemployment rate, the official, understates the health of the employment market.
Yes. So they finally have recognized that. And then I see a report like this that comes from Freddie Mac, which essentially I consider the government, the August 2013 U.S. Economic and Housing Market Outlook, where they explained 3 reasons why housing is the key driving force to the overall economic recovery, and that housing is basically helping rebuild the American economy. And the challenge, and the report explains that the path of recovery has been historically slow and that the Great Recession officially ended in June 2009. And with the release of the second quarter GDP, we now have data on 4 full years of this economic recovery. And the data released confirmed that many have felt 4 years of recovery have only brought lackluster growth. Now, compared to all the other prior post-war recoveries, and I'm citing all this stuff from the report, the expansion has been the weakest. Real GDP has risen by only 9% since the recession officially ended, while it grew an average of 17.4% in the 4 years following the end of the previous 10 recessions. And might I point out that the only reason that we've even had any sort of increase is because of the artificial manipulation of interest rates and the access to cheap money presented by the Fed.
Correct.
And so the answer for Freddie Mac is what's going to drive this economy is housing. And they have 3 reasons for why they're going to do housing is going to do this. The first is that the demand for housing will drive employment. Okay? How that happens, I don't know. But it says increased demand for housing will help stimulate new single-family and multifamily construction and boost home sales. We expect starts to hover just below 1 million over the second half of the year, the best 6-month building pace since the first half of 2008. This increased building and sales will add approximately 0.3 of a percentage point directly to GDP growth through the residential fixed investment and will employ many more workers in construction at other housing-related firms. Now, let me just address one thing here. So
please do.
That's great that you feel like more housing starts, new home builds are going to increase here. But what's going to happen when interest rates have now risen almost 2%, and now these home builders realize, well, crap, we just built this house, now all of a sudden half the people that we were banking on getting mortgages don't even qualify anymore. Now
so they're going to build more on spec once they realize that, right? They're just going to go out and build more houses.
They're just going to go out and build more houses, which is exactly what happened the last time.
Actually, I disagree. I'm being facetious. They're not going to do that. I mean, they might do that if they've somehow become delusional like they did last time. But I think your point is if rates have gone up 2% and now all the houses that they've built for people and people start not being able to buy them, they're not going to go out and continue to build houses to fill Freddie Mac's or Fannie Mae's rosy scenario that now they're going to drive the economy by building more houses.
But see, I think Louis, that there is some delusion that's actually going on though. I do feel like that,
could be right.
The builders
wouldn't be the first time.
Yeah, it's not the first time. And remember, much like the stock market kind of is forced into following the Fed so closely, I think that the home builders feel like the Fed's there to backstop them too, and that they'll do anything necessary that if things start to slow down to buy mortgage-backed securities.
Well, you're right. And also, as managers of those companies, they get paid to take risks. They have no downside if they're wrong. So if, let's say, somehow it turns out the housing market continues to roll along for another couple of years and they invested the money, they've come out smelling like roses, they get big bonuses. If it turns the other way, they can always claim unexpected, who saw this coming, and they won't lose their jobs and maybe they'll get a less of a bonus, but it's really, they've put these people in a position, you're right, if you think the Fed has your back, where you basically can privatize your gains and socialize the losses. And you have no consequences, and that always leads to malinvestment. If someone just hands you money and says, go spend it with no consequences, you're not going to spend it wisely.
Yeah, and, another thing that I was paying a lot of attention to over the last couple of years is, obviously the pace of building has picked up now because a lot of the land that these builders have been sitting on since when they bought back in 2006, 7, and 8, and 9 at the prices that they bought out, it didn't make sense for them to build on it. They had to sit on it. They had to sit on that land until prices rose by enough to where they could at least start to break even or turn a profit. So, this large increase in housing starts is not shocking to me by any means, especially in the D.C., Maryland, Northern Virginia area where prices...
They built no homes for about 3 years.
Sure, and prices have been increasing. In the D.C. metro area, they've been building houses around here like hotcakes. So this is not necessarily anything new to this area. For some of the areas around the country where the jobs aren't as plentiful, I think that's where more of the buildings picked up a little bit more in those regions. But here in D.C. Metro, it's been moving, and it's been moving for some time. The second thing that Freddie Mac said was that rising prices equal increased family wealth, which equals increased spending. Now, do you have a problem with that, Louis?
Absolutely. Both statements.
So, and their summation of this was that the housing being the biggest asset of the most American households, rising house prices directly affect the balance sheet of homeowners. Home equity is the largest component of net wealth for many families. As wealth rises, households generally increase their consumption spending. They may even tap into their equity through a home equity loan, using the proceeds for either consumption or investment spending. Some evidence that home equity lending has picked up was found in Freddie Mac's refinance report for the second quarter, which saw $9.5 billion in home equity cashed out as part of refinance, up from a year ago. Okay, so great. The whole thing, the way our economy is going to turn around is rising prices so people can take out more debt and then spend it.
And buy stuff that they can't afford other than borrowing it.
Right. So now they didn't get an increase in their wages.
Nope.
They've just now taken out another loan that they've went out and bought a boat or car, whatever that was. Now they have another loan that they make.
Because their house went up, not because they produced anything.
Exactly. And that's my biggest thing. Our whole economy is not built on productivity. It's not. It's built on debt.
And the Fed is encouraging it. They're not saying we need to rebuild our economy, to increase our productivity, to bring back manufacturing. They're saying, no, we need more people moving in and out of houses at low interest rates in this musical chairs economy so that people will feel richer and buy stocks so they'll feel richer and then take those proceeds and go out and buy stuff. It's the entire debt-based, consumption-based economy rather than a production and savings economy.
Yeah,
and the biggest problem with that economy is you can only go further and further into debt if you want to grow.
Absolutely.
You have to borrow more money to make more money to increase your GDP, and you have to go further into debt to get a greater financial benefit.
And isn't it's this is what.
And when you stop the debt, the economy comes to a crash.
Right. I mean, this is people are being brainwashed into thinking that this is
What did George Bush say? Go out and buy something. That'll help the economy. When we had after 9/11.
Don't say
this isn't a Republican or Democrat thing. You're right. This is a cultural mentality that's been imposed upon us that somehow we are the great American consumer and we can spend money better than anybody else. That's ridiculous. Right. You could teach anybody how to spend money. It sounds like the United States has some kind of special trait where it knows how to go out and get to Walmart better than anybody else and crash the gates down and buy stuff.
Yeah, and I mean, the fact that there's a report like this coming from Freddie Mac, and don't think that Congress, that the President, that the Fed, they're not all in the same boat, okay? They are all in this, and they know that if housing's not moving, that as a country we are screwed, okay?
Right, not because they realize that housing shouldn't drive the economy. It's because they realize the whole thing is designed that it does drive the economy, and if it doesn't drive the economy, they got nothing else.
Nothing, because there's nobody out there saying that companies should be more productive and that banks should be lending to small business to drive more productivity.
Or we should get that cash back that's held overseas, or that we should reduce regulations. Or none of that. It's all how can we get more people moving in and out of houses?
How can we get banks to take more risks on small business to allow them to grow? No, we don't get any of that.
No, you don't hear that.
And so then we go to the last one, right, which is kind of in that same realm there. Small business development is funded through home equity. Really? That's what
I'm going to do. I'm thinking about getting a house so I can fund my business.
Right. And here's the explanation. Rising house prices will help the economic recovery by spurring small business formation. As business owners' home often serves as collateral for a startup. Small business growth has been very weak during recovery. Recent research by analysts at the U.S. Census Bureau and University of Maryland indicated that slow house price growth has been a key contributing factor to anemic small business growth. According to their analysts, 42% of the decline in the performance of young firms is due to declines in home prices. Really?
Of course it is.
Yeah. I mean, it's everything in this report is completely asinine. I mean, what they should be coming out is telling, look, housing is not, it is some sort of a driver to the economy, but it's not for everybody. You know what I mean? You don't buy a home because you think that it's going to drive employment. You don't buy a home because you think it's going to increase your wealth. You don't buy a home because you think it's going to help you start a business. That's not why you buy a home. You buy a home because, number one, especially with low fixed rates, it's going to lock you in and keep your cost of shelter at a fixed price for a 30-year period.
It's a financial decision, but not necessarily an investment one.
Exactly. Now, and we talk about this all the time, Louis, that, real estate can be an investment as well, but not when you're buying a primary residence.
No, of course. When you're getting cash flow from rents and so on, that is an investment.
Exactly. And an investment.
But that doesn't make up the bulk of real. But that's not what they're talking about. They want people to go out and buy more primary residences and move up to other homes and move in and out of houses. They're not trying to stimulate, which is what they did, the investment part of the real estate market. But that is exactly what they did.
So let me get this straight then, Louis. If we have rising interest rates and wages aren't rising, how can anybody move up?
Well, there you go. Well, what about, forget people moving up, what about people, first-time home buyers? We've talked about this many times. How are the young people, the millennials, going to buy houses when they don't have jobs or they have part-time jobs and they have massive amounts of student debt and home prices are rising and interest rates are rising? Not the best time to decide that you're going to go out and buy a house as prices are rising.
Okay.
And you don't have a full-time job.
Louis, I got your problem solved. You ready? Okay.
Go ahead.
FHA just came out and they basically said that, guess what, guys? I don't care that you just had a foreclosure or short sale or a bankruptcy where we used to make you wait 2 or 3 years. If you had one of those, you can wait 1 year.
Why not?
Okay? Because what do they realize now? They probably do realize that these people can't continue to move up. And so who are the only people that are available to buy these homes now? Are the people that got foreclosed on, went through a bankruptcy, or got their homes sold through a short sale. We want to put them back in the market to be able to buy again because that's going to continue to drive housing, right?
Think of what they do. They create demand by bringing these people into the market, and then they control inventory. And when you control both supply and demand by creating demand artificially and then creating supply restrictions artificially, then you get higher prices. We see that in the stock market. They do the same thing, right? The companies buy back their shares, reduces the supply, and then the Fed increases the demand because interest rates are zero and people have to go out and buy stocks. There's fewer shares available to buy, so the price goes higher. Doesn't mean the companies are doing that much better. Think about how high the stock market has gone in the last 4 years. What is it, over 100%? The economy hasn't grown 100%. Same with housing prices. It's all based on manipulation of supply and demand and creating buyers and restricting demand both artificially.
Well, we did have Obama out there talking about
he understands all this stuff, too.
Yeah, and how he planned on shutting down Fannie Mae and Freddie Mac at some point, right? But yet he's not paying attention to the Federal Housing Administration allowing borrowers to basically get a home if they meet certain criteria to be able to buy it.
You can't blame it. You know what? The president doesn't know. He's not supposed to know anything about housing. And maybe if he does, the thing is, he's just out there to say something that appeals to somebody, enough people, based on polling. Right. He doesn't have to get results. Politicians are not held accountable for results. They're basically running a popularity contest, and it made sense when the president likes to get behind an issue. They generally like to get behind an issue at the bottom of a crisis or when things are looking good.
Well, I would just think that the president would be out there touting this more than let's shut down Fannie and Freddie because this is actually allowing.
You're right. Politically, it didn't make any sense economically or politically why he's out there talking about shutting down Freddie Mac and Fannie Mae. Unless he knows something we don't know and they collapse in 3 months, he can say, "See, I told you all along." I don't know. Doesn't make any sense. We talked about that last week.
Yeah, and I did want to, so for people that are out there, right, that have went through, experienced a short sale, a bankruptcy, and a foreclosure, you had to wait 3 years from the date of that foreclosure sale before you could take out another FHA loan. For a short sale, it was 2 years, actually 2 years in certain circumstances, but 3 years. And then for bankruptcy, it had to be 2 years from the discharge date. So now, with the new mortgagee letter that was just released by FHA, what's going to happen is that if you've been foreclosed on, been through a bankruptcy or a short sale, and this was due to some sort of recession-related financial event, which they're basically, FHA is stating that it realizes that credit histories may not fully reflect their true ability or propensity to repay a mortgage, and they can document that there were certain credit impairments, basically a loss of employment or loss of income that was beyond the borrower's control. The only documentation you need to provide is that your income loss was at least 20% for a period lasting for at least 6 months. So I'm assuming that, if you lost one of your part-time jobs or something like that, that's going to be good enough. And many people obviously lost their job if that's the reason why they're losing their house.
Not hard to show.
It's not very hard to show. I think that they know that they made this. And the only other thing that you have to do is you have to start reestablishing satisfactory credit for at least 12 months. So essentially, if you know that you're going to get foreclosed on and you start working on taking out a secured credit card immediately and you're on time with that credit card for the next 12 months, then I think that you're pretty much signed me up for a mortgage 12, 13 months later. This new guidance is for case numbers that are going to be assigned on or after August 15th of this month, and it's effective through September 30th, 2016. Okay, so they've made this now good through the next 3+ years. So obviously they can see that this is something potentially that would allow more people to enter back into the housing markets. Okay, now, do I agree with this? Absolutely not. I don't agree with it at all. I think that once again you're going back down that treacherous path of lending to people that you probably shouldn't lend to. And do I feel like 1 year of showing that you've been on time with stuff is enough? No. I wouldn't lend my money.
Case by case, maybe, but not as a general edict nationwide by FHA.
Exactly. Should there be exceptions to the rule? Absolutely. Do you have, is there a divorce or something that causes something? Is that they have to split the property and they can't get out of it because they're upside down? I mean, those type of situations, common sense makes sense. But if it's just because a lot of people were spending money on things they probably shouldn't be spending on and decided to make a strategic decision, but then they'll somehow be able to come up with the documentation that says that they lost that 20%, you don't want to be lending out to those people. And you want to show that they've at least got 2-3 years of their feet underneath of them. Why, if you've only had your feet underneath you for a year, do you want to jump right back into buying? It doesn't really make rational sense to me.
Well, they're pushing you back towards it. It's like when you've gotten yourself clean and sober and someone's putting a drink under your nose.
And that's what bothers me more than anything else is that this is just to keep the party going, right?
But for whose benefit, though? If you think about it, it's not for the. They try to make it sound like it's for the benefit of the people who want to live in homes. No, it's so the banks can make more money, lending money, without any risk.
It's so they can continue to make money, and it's also so that the numbers of the economy can continue to not be...
Helps the politicians, and it helps
right, exactly.
They work together.
Because if they weren't doing this, we'd have like negative GDP because everybody...
Then who would vote for these guys?
Right, I mean...
You know what? People would vote for them anyway, unfortunately.
Well, it's true. But, I mean, they might go start businesses with their equity or something like that, Lewis. I mean, come on.
Yeah, you just gave me a great idea. I need to go out and buy a house, hope it goes up, take the money out, and put it into my business. Instead of
necessarily
working on my business.
Hold on, but you could take some of the money you have in savings, right, and actually start your business and try to help grow and fund your business to be more productive, to make more money, to where you could save that money to buy a house if you wanted to later on down the road. That doesn't
unfortunately,
make sense.
Unfortunately, most people don't even have savings in the form of cash anymore, but they're forced to have it somehow in the stock market.
Which is why they always continue to push you back to home ownership, where they feel like you're going to gain, money. You're going to get money just by buying a house. That's what's going to happen. You're going to get money.
Yeah, the idea is if the stock market goes up, people feel wealthy. If they have big gains in the stock market, they can take that money and then go buy a house and then keep the whole spending thing going. And the house goes up, they can take the money out from the house going up. And, of course, if the stock market keeps going up, people have more money to go buy more houses, which drives housing prices up, so people have more equity, and they can take more money out and buy stuff. You can see how that ends. You can't push that forever.
No.
There's nothing behind that. You're just dealing with valuations, but you're not dealing with any underlying productive capacity, any underlying creation of anything of any value, other than you've pushed prices higher, which is not the same as value.
No, and it's going to be really interesting because obviously we had, I think it was Wednesday, existing home sales. They were obviously up some of the highest levels that we've had in however many years. But once again, the numbers that we're seeing from July, from June, those to me don't really matter at this point, because guess what?
Well, right, aren't those the people who got locked into their mortgages and made historic low rates?
Precisely, Louis. So the only numbers that I care about are the ones moving forward, from the ones where we've had interest rates in the mid-4s to close to 5% at this point.
Well, your mortgage applications, that's a thing to look at. I mean, the refi
and we've already seen there's been, 30% drop in those. I mean, the refinance applications are pretty much non-existent. But what we will start to see, Louis, and Freddie Mac points this out so poignantly to us, is that we're going to start to see more cash-out refinances. So even though people may be locked in at a lower interest rate right now, Louis, let's say they're at 4%, but they want to tap into some of that equity, guess what they have to do? They have to take out a 4.75 loan to get that cash out, and they're going to do it. They're going to do it.
That's true.
Because
they'll feel like that's okay because it's not the same as a credit card,
yep.
And they're hoping their home is going to continue to rise, so where's the problem?
Well, and you know what the rationalization is going to be is, well, if I can borrow $50,000 from my house and amortize that over 30 years, and it's only going to cost me like an extra $100 a month, why not do that?
Sure.
You know what I mean? I don't.
You know what? That type of thinking always leads to, well, if that makes sense, why not do $100,000 if I can?
Exactly. But the thing that we always talk about is that why would you want to mess with your fixed cost, your long-term cost of shelter, if you can fix it in a low 30%?
Because that's not why they bought it in the first place, though.
I know. But that's more of what we're, this show is we're trying to tell people that these are the things that, maybe not everybody focuses on, but I think that are important that you should focus on them. Because if you want long-term stability, if you want to, set yourself up to put yourself in a position where you're not necessarily worried about what happens economically, if you're not worried about what the Fed's going to say, because you know what, you're set at 3%, 30-year fixed, nothing's changing for you for 30 years, and you could care less if your house goes up by 500 or goes down by 300. You know what I mean? Other
than rising property taxes, you've locked in your cost of shelter at 2011-12 prices.
And see, that's where I'm at right now, Louis. I no longer care, what my property value rises up to. I don't plan on moving for 15, 20 years. I know that my costs are locked in. I don't have to worry about that. That check goes out the same every single month. The only thing that can change is the insurance and the taxes. That's it. But if I were...
And also, you're counting on your business to drive your income, not your house.
Exactly.
So you're going to focus... I mean, there's nothing you can do to raise your house values except maybe cheerlead. Go house, go up higher. I mean, if you have a business, there's things you can do to make more money.
Well, not only that, but you should be able to learn from the past, right? We should be able to look back and say, what happened the last time that we saw something like this? And what were the repercussions of that?
Yeah, people do. This time is different.
Yeah, but I think it's because...
It never is, but they always say this time is different.
Well, when you have the Fed and the government cheerleading this type of stuff, and you've got Freddie Mac coming out with reports like this, I mean, who wouldn't buy into this stuff, right? I mean, they're not going to look at things rationally and say, you know what, I'm going to stay put. I'm not going to make another move right now because I'm at...
Right, if you think the housing crisis and the low interest rates and the housing bubble got us into this problem, and now they're saying explicitly, we need to create another housing bubble to drive housing prices back up because that's what drives the economy. Now, you'd have to be a complete idiot not to realize they're purposely not trying to learn from the past, and they're purposely trying to do it again because they don't know what else to do. And if you fall for it, it really is, what is that old expression that fool me once, shame on me, fool me twice. I mean, fool me once, shame on you, fool me twice. We don't get fooled again, as George Bush said. Remember, he mangled that one. It's fool me once, shame on you, fool me twice, shame on me. And that's where we're headed right now. We're just repeating the entire issue.
Yeah, I mean, we definitely are. And I mean,
and if you're warning about it, you're a kook because don't you see the stock market is higher? Don't you see the recovery? What's your problem? It's like you're at a party and you're on a moving on a boat and you're headed towards the waterfall, and you're trying to warn people that you're going over the thing. So this is a great party. Why don't you shut up?
Right, yeah.
That's what's happening right now. They're saying, well, what's your problem?
Right,
your
stock portfolio's up. Your stock portfolio's up. Your house is going up 20% this year. I mean,
what's not to like?
No, what's not to like? Next year it's going to go up by 30%, right?
Of course it is.
just because we're going to.
And if it doesn't, who could have predicted this? Oh, that crazy guy over there.
Right. Yeah.
Hey, think about all the people that predicted the financial crisis. There weren't many of them, but they were very high profile. They were screaming housing bubble for a couple of years before it happened. They were talking about what the consequences would be. Jim Rogers, Mark Faber, Peter Schiff, those kind of guys. When it happened, and they said it would happen, no one went to them and said, how did you know this? Ron Paul's another one. They're not listening to them now. They're taking all the advice from the people who didn't see it in the first place and are making the same mistakes again.
Yeah, and I mean, you can see right now that it is the same thing all over again. I mean, it doesn't take a rocket science to figure
on a smaller scale, but it's the same concept.
Scale. Right, it's the same concept. And, that whole report from Freddie Mac, when they talked about, that we're coming out of the recession and it's going to be led by housing. Well, the bottom line is, to me, is that we never actually came out of the recession.
Correct.
We're still in it. And unfortunately, the only reason it's a mirage going on because it looks like we came out of it because of the artificial interest rate environment that was created, cheap money that's out there that allows for the malinvestment, that allows for people to buy homes because of 3% interest rates. And we're really going to start to see where the economy's gone when we have an interest rate between 4.5% and 6%. If we get to those levels, we'll really get to see where things are because that's really going to change people's buying power. It's going to change their decision making on whether they're going to buy another house. I would love to see what's going to happen when we get those spring numbers from what's happened this fall, because to me that'll be a lot more telling than back in May and June where we had.
Well, what are you seeing right now? I mean, Ryan, you're in the market day to day. Has there been a drop off in the mortgage application business, even in the D.C. metro area?
Absolutely. Absolutely.
And that's a hot market.
Yeah, absolutely. And nobody will come right out and tell you that because everybody wants to make it seem like, everything is just peachy because that's part of what it starts at the top, right?
Yeah, no one likes a party pooper.
Yeah, nobody likes the party pooper. Nobody wants somebody coming out and saying, hey, things are kind of slow right now. What's going on? Well, interest rates are rising. It's common sense. It's what happens.
Well, no, you hear interest rates rising. This bowls me over. Rising interest rates are good because it indicates the economy is growing. Interest rates rose 80% in 6 weeks or 7 weeks or 8 weeks, whatever it was, in that short period of time. The economy didn't grow 80% in 2 months.
No.
That's not an indication of an improving economy. It's an indication that the Fed's not going to buy bonds anymore.
But all the economists are out there touting that the reason why we need to taper is because, hey, guess what? The economy's improved. Well,
take the training wheels off. Yeah. If they really believe that, they would have taken them off last week, last month, 2 months ago, 3 months ago. People overlook this. Bernanke said just a month ago, we cannot let interest rates go higher because the economy is weak, and if interest rates went higher, the economy would tank. Bernanke is not an idiot. He knows that. He said it, and no one paid attention to it. If you Google that term, Bernanke, economy will tank, you know what comes up? My article. My little rinky-dink, small-gold website shows up on the front page for that quote. Not Wall Street Journal, not Reuters, not AP, not all the top news outlets. My site.
Well,
I didn't make it up. It's a quote that he said.
Right.
He said it to Congress. He didn't say it in a hidden camera where Mother Jones was hiding and found, like they did with Mitt Romney, him say something off the cuff. He said it in a congressional testimony as part of a question-answer period. He said the economy is weak, and the economy would tank if rates went higher.
And it gets basically no play at all.
He didn't even have to retract it because no one asked him about it further.
I mean, it is absolutely mind-boggling. How some of this stuff just slips through the cracks and nobody wants to. But I mean, it's just part of the game. It's just pretend like everything is going the way it's supposed to. And like I said, you and I have been talking about this for a long time, and we know there's no tapering. I mean, would you agree with me that we're probably not likely to see any tapering this year?
Unless they can come up, I think they won't taper it. If they do taper, is like some nominal amount that's symbolic. They can say they can do it, but then they'll couch it in. Well, we might have to increase it. Or they start
creating those reverse repo programs, or who knows what else. to come in behind it. But, I mean, bottom line is that, you know, from an interest rate environment where we're at now, I think that I've already seen, you know, from me being on the ground, I've already seen that there's been a pretty substantial decrease in the amount of people that are, A, refinancing and B, buying as a result of the interest rate. So once they start to get this data, they're going to realize the same thing. But we still are seeing a little bit of an uptick of people buying right now, only because those were the people that were sitting on the fence saying to themselves, well, you know what, we'll wait. Now, their current home has gone up in value enough where they've got equity in there that even with the increase in interest rates, they've still got some money to put down on a new home that they're still considering doing so because they don't want rates to go up to the 6% level, so it's forcing them to do something now. Now, also, in that same breath, there are mortgage programs out there, even for jumbo mortgages, for adjustable rate mortgages for 5 and 7 years that are close to 3 to 3.5%. Okay, so what's going to happen is, and don't think that we're not going to see this from Fannie and Freddie, them coming out saying, you know, well, ARM rates, we've seen an uptick in ARM rates, or a decrease in ARM rates, but an increase in application for ARMs in these levels. Well, that's going to be the next thing. When housing starts to slow, they're going to have to start to pump something back out there. And the adjustable rate mortgage will be the program of the future again as soon as we start to have rising fixed rates.
But Ryan, what about last time, you know, they had those, but the rates, first of all, weren't as low, and they didn't rise as rapidly. But when they did rise, they did create a massive problem. But right now, what if the rate of increase in interest rates even gets halved of what it's been in the last couple of months? That's still a very fast interest increase, and you can get wiped out in an ARM pretty quickly if you have those faster rising interest rates.
Yeah, I mean, and, you know, those type of programs, and that's why it's always important if you're taking out one of those products that, you know, you've got an exit strategy because, you know, I mean, you could have your first, I mean,
like the Fed has.
Yeah, and most of the time those adjustable rates are capped as to how much they can go up after the initial period by no more than like 1 to 2% in the first year. But that's still a substantial jump. So what I always tell people, if you're factoring that in, you need to factor in the worst case scenario. If this ARM adjusted in 5 years or 7 years, what that payment would be, and could you still make that payment? And if you can't, then that's probably not necessarily the best product for you, even if you have to pay, you know, 1% or 1.5% more for the fixed rate.
Ryan, what as a lender do you do other than advise? Are there restrictions? In other words, do you have to prove that you could repay the loan if there was an increase to those amounts, the 1 or 2% extra, or do you take their credit on the basis that they can meet the payment as is now with a small rise?
Most of the time when you're working off of a 5-year or 7-year adjustable, it's off of the original note rate. It's not off of the rate that it
could go to.
Exactly. The only one I think that is that way is the 3-year because it's a shorter one.
Right.
The 3-year
and more likely
do it off of exactly, but the 5 and 7 they basically consider that like, hey, that's a normal loan. We'll just give it to you at that rate and we'll qualify you off that rate. So yeah, I mean, and when you know that, I mean, and most people are going to be like, oh well, you know, I'll probably end up moving in 5 to 7 years anyway. Where I see the issue is if obviously home prices were to decline, you could be stuck in a house again. And that's what happened the last time was that everybody got into these adjustable rate mortgages because equity was rising and rising so fastly that every couple of years they could refinance and it was no big deal. So if you get into an adjustable, you just need to have an understanding that there's a chance that you can't get back out of it and that you'll be stuck paying a higher payment. But if you know all those things and you understand the way these programs work, they're not necessarily the worst thing for you. But make sure that
you have to understand them.
Yeah, you have to understand. You have to understand what happens after that initial period's up. You have to understand that if you need to, at the end of that time, if you want to refinance, that there's going to be costs associated with that, and it's going to be at the going rate. Now, there are some products out there like credit unions and certain banks that they have written right into the note that after the adjustable rate period is up that they'll convert it to a fixed rate. It may be like a 1% above what their adjustable rate was.
I have seen that. I think I had that when I bought my first house maybe 10 years ago.
Yeah, and I mean, so I don't like to, say that there's one set way, because you know what? There's always a bank or a credit union out there that does things a little bit differently. But if you're searching for these types of products, that's why it's important to really do your research and make sure that you're doing something that's going to be the best thing for you and your family financially long term. You know, if you guys have any questions, I mean, I'd be glad to point you in the right direction. Even if I can't help you out, I do follow a lot of what's going on out there. Sometimes, you know, a regular lender, a normal lender can get a deal that the credit union can't get done, and sometimes it's the other way around. Sometimes the credit union will say, you know what, you've been a loyal customer of ours for so long, we don't even care that your credit scores don't meet ours. We'll portfolio this loan. And when I say portfolio, that just means that they're not going to sell that loan, so they can basically set their own underwriting guidelines. As long as they're going to hold it for a year or two, they can sell it after they have a history of you performing.
Right. Unfortunately, that market is so tiny.
It is. It is very tiny. I had a client not too long ago that actually was able to do that. She put, I want to say it was 20% down. She had a short sale. It was 2 years out from the short sale. Nobody would touch her, but her credit union said, you put 20% down, you've been a good customer of ours, we'll give you an adjustable rate of 7-year. She got a 7-year adjustable at like 2.75%. It was something absurd. So, you know, right when I start to tell people, hey, that can't be done, you go, you talk to a certain bank. If you've got money in the bank, money talks. That's the bottom line. If you've got money, if you can minimize their exposure, they're more willing to do something than not. But if you try to go to a regular lender to get that done, it's probably not going to happen.
Voting talks, too. I guess if you can vote for politicians who will give out free money,
sure,
and make it easy for you to buy a home, in a way, you don't need money. You just need to have a vote.
Absolutely. Absolutely. You know, we're coming up on the end of the show, Louis, but I did want to give our credits for the week, which kind of filters into the whole qualifying for a mortgage and
Great.
stuff like that. I often get asked, you know, what items should you pay off first if you're trying to get your credit score up? Let's say that, you know, you're at 680, and you know, the lender can tell you, well, you need to be at a 700 or 720 in order for you to be able to get this type of loan, and you're just like, well, how am I going to do that? I don't know how I can do that. What should I pay off first? Well, and this comes directly from my buddies at the Credit Pros, who basically is a legal credit repair company. Basically, they're attorneys, so they know exactly what they're doing. They say that the dues, the ones that you want to pay off first, are credit cards and other revolving accounts, and collections if the creditor will agree to remove the item from your credit reports. Okay? The ones that you don't pay off are older unpaid collections unless they agree to delete them, installment loans, and student loan debt. Now,
hey, Ryan, how do you know if a loan, if you're getting a credit request, not a credit request, but a debt collection to you, whether they have the ability to hit your credit or not, whether you should pay that?
Well, most of the time, they'll give you a notice that you've been reported to a collection agency. You know what I mean? They'll give you a written notice
Right.
for that, which most of the time, most of those collection agencies report right on your credit report, because it doesn't do them no good to not report, because how are they ever going to get their money? You know what I mean?
Okay. So the credit, what you're saying is those reporting agencies, not reporting agencies, the credit collection agencies generally have a direct line to the reporting agencies.
Absolutely, because they know that typically when people are going to apply for loans, that's when they're going to want to try to settle up on these type of things, right? So that, and by checking your credit report every 6 months, is the other way to find out if you've got the stuff on your credit report, right? You want to be doing that check every 6 months or at least once a year to verify that there isn't anything like a stupid DC parking ticket that shows up on there, or something from you getting a camera from a traffic light camera, ran through the red light, now you got a ticket, and now it's turned into a collection somehow. Those are the type of things that, yeah, you may not ever know about until you pull your credit. But for those revolving accounts that you have, there's a secret that the credit pros have found, which is basically that they have a sweet spot, which is to have about 5 revolving accounts. I know that seems like a lot, but they said with about 5 revolving accounts, if you keep 3 of them with a small balance, like a very small balance, like let's just say 1% of whatever your high credit limit is, and the other 2 with like a 0 balance, you'll get a significant boost in your credit score. You got to remember that almost 30-some% of your credit score is just the proportion of balances to high credit limits, right? So if you take and you just zoom in, you just focus on those revolving accounts, and you can pay them down. Basically, you're almost paying them off, but in keeping 3 of them to a very small balance, like less than 1% of the high credit limit, you'll see a substantial increase in your credit score almost immediately. So before you go paying off car loans and doing things that you think are going to increase your credit score, remember that once you close an installment loan or any type of loan, it's done. Versus a revolving loan, but if you pay it, even if you pay it down to 0 or 1%, it's still going, right? It's revolving every single month. That's why they put such a significant weight of credit score on those items. So that is going to be the biggest tip for people out there. If you're looking for where to start first, it's going to be those credit cards or revolving accounts, and to get rid of collections if the creditor, allows you to remove them permanently from the credit report. Now, once again,
wait, Ryan, if you have 3 credit cards, not 5, should you go out and get 2 more and keep low balances on them?
Well, you don't. Yeah, but like, let's say that you know that you're going to apply for something in the next year or so, you might want to do that. But if you only have 3 right now and you want to go apply for a new mortgage, I wouldn't go do that, because what's going to happen is you're going to get hit inquiries for those new accounts. Then you're only going to have been rated for those accounts for like 1 month or 2 months before you go to apply for something else.
So you should take one of them down then.
Absolutely. So if you have 3 accounts, what I would recommend doing is probably paying 2 of them, keeping 2 of them to a small balance of less than 1% of your high credit limit.
And running the other one.
And then maybe the third one, you can keep at a 0 balance, wherever you want to do there. But just whatever you have going on, kind of use this as a baseline. But definitely, probably, if you're going to take out a loan, the last thing you want to do is to take out 2 credit cards right before you do that, because then they're going to ask you, okay, why did you do that? And then they'll scrutinize you even further.
But if you have 5, you want to knock a couple of those down.
Oh, absolutely. Absolutely. And I mean, there are very sophisticated credit score.
Well, you can actually borrow money from one. They always send you these checks where you can pay off you can switch from one account to the other, can't you? Just transfer balances? Yeah,
balance transfers, or use cash. And a lot of the time they'll say, hey, there's no interest on this for 6 months or whatever it might be. So, there's a bunch of things that you can do there. And, let's say you get in a scenario where you only need 20 points. I mean, this could be something that could easily be done. It's just transferring balances to get it to where it's in the sweet spot, where you might get a 30-point increase in literally no time at all. And this could be the difference between 0.25% and mortgage interest rates, which over a 3-year period is a lot of interest. So, once again, these are just small little tips that are set up to help you guys. If you do have any credit issues, I'd be glad to pass you on to the company that we use. We use 2 different companies, but the main one we use is the Credit Pros. If you can reach out to me at 877-245-2030, and I'd be glad to put you in contact with them. Louis, I appreciate you coming on today. Great show as always. And if our listeners want to get in contact with you, any questions they may have, or are interested in the services that you offer, how can they do so?
You can go to smallgold.com, SMAULGLD.com, and there you'll find economics and real estate information, blog posts relating to some of the topics that we discuss on the show. And if you'd like to contact me, I'm easily contactable through the About section on the website, and I offer real estate consulting services, marketing services for realtors and brokers who are looking to improve their website conversion and increase their presence online. So if you go to smallgold.com, I'd be delighted to work with you.
Perfect, Louis. I appreciate it, man. Have a great week.
You as well. Thanks, Ryan.
Thanks, guys, for tuning in. We appreciate you listening. And as always, I hope you got a lot out of today's show. If you have any other questions or concerns for us, the 800 number is 877-245-2030. That's 877-245-2030. You can reach out via the web at Real Estate 360.